Let's start with FedEx, which reported a surprise beat last quarter, but Morgan Stanley is still bearish for its part, expecting a miss in express and freight as volumes drop after the holiday quarter and the company continues to cut costs. Lee, what would you do here?
You know, I wouldn't touch this thing. You know, so many value investors last year lost money on this thing. Here's my issue with it. The Express, what we think of as like regular FedEx, it's just not growing. It just doesn't have the growth. A lot of the growth is about a little less than 40%, which is, FedEx Ground. Here's my problem. All management can do is talk about how they've done all this big CapEx. They got a young fleet in terms of their airlines and all this stuff. But at the end of the day, until they harmonize the experience of ground and what we call express, I think it's a no-go zone. I don't like the service. I just don't think it works.
All right, we'll move along then. We'll see if FedEx can beat those low expectations. But we'll talk General Mills then, which is up 4% this year, with Piper Sandler projecting an increase in promotions. We were talking about this, and a broader retail slowdown, but still expecting the pet category to help. General Mills, what do you do with this one, Lee?
You know, usually if I just want to buy value stocks, which I'm akin to, I'll just buy the Russell, 1000, buy an ETF. I actually like General Mills. And I know it's not my type of fast growing. It's kind of like the old Lee where I liked, widow and orphans. If you need a widow and orphan stock yielding almost 3.5%, I like this. I'm not concerned about the slowdown because I think people will be trading down and want to eat cereal at home. I think that behavior is there. So I think if we have a slowdown in the economy, it'll be a nice, safe play. But I'll tell you, the pet food makes it hot. You got a lot of analysts. They're all like excited about pet food. It's kind of a buzzy thing in analyst land. So if you're looking for a widow and orphan stock, I like this. And it's a cheaper PE than the broader value index.
I look at it and wonder if we're just getting a message from General Mills, Pepsi, Mondelez that there's more consumer disinflation or deflation to come. And even the pet category is competitive. Look at the rise of fresh pet. People sometimes are just, if they're going to pay, they want to pay for the really good stuff.
Yeah. Totally agree with that. I think that we're going to see, I don't think that we see in the numbers the disinflation of a lot of just basic consumer products yet. I think people are in disbelief that that price pressure is going to be relieved.
Yeah. All right, let's move along to Paychex, Lee, which also is about to report. They're actually on pace for their 5th positive month in 6. Feels like a good sign for the economy. RBC expects professional services demand to offset losses from the wind down of the employee retention tax credit. That's an interesting angle there. They also see opportunity in pricing. I don't know, do you like Paychex? Do you have to worry about a slowing labor market, or is the stock kind of immune from all of that?
I don't think the stock's immune for it. I understand the long-term story. I mean, Paycheck has just been payola for people who've owned it for a long time and have been patient. Here's what my problem is. They're not even, we're not even going to get to see 5% growth. I mean, we have a stock that's under 8, 7, 6% growth. It's not at a big discount in terms of its valuation. And it's not that people don't want to hire out there. When you listen to management talk, they're saying we just can't find people to hire. So I don't really know where that organic growth engine's going to be. At best, what's it going to be? Flat? At worst, we get a little softness in labor markets, lower volumes. I'm just not into this. I'd rather buy an index fund than Paychex.